On the left hand side, it says enter value. So we are only going to put the values on these yellow highlighted areas. So what this sheet helps you with, let's take an example that you want to buy a $750,000 home in Ontario, and you want to know with the down payment that you have saved and with the interest rate that you will be getting from a bank, how much income would be required to buy that home. So this sheet will help you to know what is the income requirement to buy a home. These are the actual exact calculations which a bank will be doing. Why? Because this calculator is following all the Canadian mortgage standard rules. So I'll show you step by step how to use it. It's very easy to use. So I'll start from here. So first thing we are going to enter is the purchase price of the home that we are looking to get. So in this example, it's $750,000. So as soon as you enter the purchase price, on the right hand side, it is telling that $50,000 is the minimum down payment required to buy a $750,000 home. Okay, so now we'll come back to the next point, that is down payment. Here, we will be entering the down payment that we have saved to buy this house. Let's take an example that we have also saved $50,000 to buy this home. So I'll just put $50,000 over here and hit enter. As I hit enter, now on the right hand side, you can see that this calculator has done some further calculations for you. What the next calculation it has done is mortgage default insurance, which we also call it as CMHC Insurance. When your down payment is less than 20%, you need to pay for an insurance premium. This insurance premium gets added to your mortgage required. So on the next option, you can see it is calculating how much is the total mortgage that would be required. How it is calculating it? It is calculating purchase price, that is $750,000 minus your down payment plus this mortgage default insurance premium. So the mortgage you will be requiring is $729,400. Now, in the next option, we will be entering what the interest rate we will be getting from the bank. So next thing, what it is calculating in the very next column, if you see, it is calculating the stress test rate, that is 6.25%. So what it stress test is that when you are going to a bank or a lender to ask for a mortgage, they will make you qualify not on the actual rate you are getting from a bank, but on a rate that is higher than your contracted rate. How this rate has been achieved, that is your contracted rate plus 2% or 5.25%, whichever is higher. So 6.25% is higher. Your mortgage payment would be $3,572.36. But the qualifying payment will be the higher payment of $4,453.23. Now on the left hand side, the next thing we need to decide is amortization, like how many years we are taking this mortgage for. So you can go up to 30 years. Now with the new rules, even the first time home buyers who are putting less than 20% down payment and those who are buying a newly built home can extend their amortization up to 30 years. Now on the right hand side, we'll talk about the monthly housing cost. What happens is any bank or any lender, when you go them to get a mortgage, they only consider the property taxes and a minimum heating amount as your utilities for the house. So here in this column, it is automatically calculating the property taxes based upon the purchase price of the house. It is estimating 0.75% of the purchase price to be the property tax and $150 per month to be the heating cost. This is the same criteria that lenders use when you visit them to get a pre-approval. Now we again come to the left hand side. It is the monthly debt. So here you have to put what your monthly debts are. Like if you have any car loan, any student loan, if you are paying on a monthly basis, you have to enter an amount. Let's suppose you have a car loan payment of $500 a month. So you have to enter here. If you are buying any condominium, it comes with a maintenance and a condo fee. So you have to enter if there is any condo fee you will be paying when buying a home. Banks consider 50% only of this condo fee for qualifying you for a home. Now I'll just stop inputting any value till here. See, based upon these inputs, that system is telling us that the minimum income required as per mortgage rules to get approved for this mortgage of $729,400 with your debt payment, you need an annual income of $157,821. Let's assume that we are making the same amount. I'm rounding it off to $158,000. So in this column, we have to input our income, what we are making on the annual basis. So I'm putting $158,000. So now we'll again come to the right hand side. It is now calculating GDS and TDS. What is gross debt service? Which means this is the percentage of your total housing expenses. This should be less than 39% as per the mortgage rules. And TDS is total debt service, means your housing expenses plus your any monthly debts that you are paying should be lesser than 44% as per the mortgage rules. So this is following the mortgage standards and giving you a figure of annual income that you require to approve for this mortgage is $157,821. But we have just mentioned that two things what banks are doing wrong. First of all, they are stretching your housing budget up to 39% of your gross income. They are not considering your net income. If you go by this, your housing budget will at least be 50 to 55% of your net take home income. If you stretch yourself to pay this much out of your income on housing, then how will you survive on the other costs that you have to incur to run your life? And the other thing the banks are doing wrong is what we mentioned here, that banks are only considering limited utilities, that is your property taxes and heating cost, to make you eligible for this mortgage. There are other housing expenses also that you have to bear once you buy the home. Those are your hydro, like electricity, your water, and then there is important expenses of home insurance as well. So they are not considering those expenses in that thing. So if I add an average amount of hydro and water, assuming it to be $200 a month, and home insurance also you have to take, that let's suppose it's $200 a month, that's $400 of an additional cost which banks are missing when they are making you qualify. And second thing, they are collecting a higher percentage of slab of your income to spend towards the housing. So on the right hand side, if you see, it gives you ideal income required to avoid becoming house poor. How this figure has been calculated of $187,318. First thing it is considering is it is limiting your housing cost up to 30% of your gross income. And the second thing, it is taking into consideration not only the property taxes and heating, but also the full picture of your housing cost, that is your other utilities of hydro, water, and home insurance. So that if you have $187,000 of income, that's how you will be comfortably getting to afford a house of $750,000. So this is how this sheet is going to help you to know what is the ideal income required to buy a home. If you also want to check how much will be the ideal income required to buy a home that you're looking to get, you can also download this planner to make an informed decision. I have added the link of this planner in this description. You can also find the link of this planner in my bio.